From New York City, for our viewers worldwide, I'm Matt Miller. Futures turned down after the second worst breadth we've had in a rally this century in yesterday's session. The countdown to the open starts right now. Coming up, futures running out of steam as Fed officials cool rate cut expectations. And the Japanese yen weakens to its lowest level since the 1980s, raising the risk of intervention. Plus, Volkswagen invests $5 billion in a joint venture with Rivian in order to gain some momentum on Tesla or any of its EV rivals. We begin with the big issue, the momentum in stocks continuing to stay very concentrated.
It has to get worse before it gets better. In other words, you need the economy to slow down. You need people to see the economy slowing down. You need the consumer to pause a little bit more, and then you have to pull Fed fund expectations forward. You need them to start cutting sooner and a lot more aggressively. And until you see that, there's no rotation.
Joining us now, Nadia Lovell is UBS Global Wealth Management Senior U.S. Equity Strategist. Nadia, great to get some time with you this morning. As I said at the top, yesterday was the second worst breadth we've seen in a rally so far this century. Only 113 stocks on the S&P participated in yesterday's rally. Is that worrying to you?
No, I mean, Matt, yes, as you noted, we've had a market that's up 15% year to date. And we would have thought that that would have been accompanied by a broad in and out and improvement in breadth. I mean, we know that we saw that at the top of the year where you had about 40% of the S&P 500 constituents outperforming in the first quarter. That's narrowed to 25%. And yeah, we're going to continue to have this ongoing debate around market concentration. But when you think about it in it of itself, it's understandable and somewhat justifiable why some of these large mega cap companies are up so much this year, because it just comes down to earnings math. I mean, the fact is there's a bifurcation in earnings coming out of that first quarter earnings season. We did see many of these companies be able to beat and raise even high expectations. And the fact that you did see like CapEx intentions around AI increase. And so we continue to think that this is a story that will continue to play out, and any sort of pullbacks that we see will be more technical in nature because the fundamentals are there. And so we don't think that this is overly a concern in terms of the market concentration, because the earnings power is coming through on these companies and they're being rewarded for it.
Nadia, a lot of this rally still seems based on optimism that the Fed's going to cut more than the dot plot shows is planned. Mickey Bowman, again yesterday, member of the Federal Reserve Board of Governors, repeated that inflation risks are to the upside and that it's not appropriate to cut right now. Is no one listening?
Well, we knew that there was dispersion among the Fed. We saw that in the updated dots. I mean, some at 0 or some at 1 or 2 cuts for this year. And of course, we're hearing that in the rhetoric in the Fed speak this week, as you noted, Bowman pointing to no cuts this year and the potential for even a rate cut if inflation ticks up again. But then you have someone like a Daly, that's more on the dovish side, and even Cook, who was pointing out that we might be near an inflection point in the labor market. I mean, we'll see what PCE holds on Friday and then payrolls next week. We know that we'll get 3 CPI between now and September. We think that the data is going to show incremental progress on that disinflation path and be able to give the Fed the evidence it needs to be able to cut. So we think September will be a live meeting. Maybe we'll get some sort of indication of that at Jackson Hole in August. So we're looking for 1 cut in September, then followed by another one in December. But you know what? I don't know if the equity market cares all that much. I mean, look at how far we have come, despite the fact that we've had this massive repricing in the rate markets down from 6 to 7 cuts to 1 to 2 cuts. I mean, as long as earnings hold in there, we think that will be enough to be able to sustain this market.
I just saw that Nvidia shares have turned negative in pre-market trading, and it looks like lately, as goes Nvidia, so goes the rest of the market. Nadia, hang on 1 second, because I want to focus in on the economy. You talk about PCE and the payrolls data. We heard Neil Dutta earlier on Surveillance say those are the only data points that matter. But a lot of people are paying close attention to housing, and we got some of that out this morning as well. Bloomberg's Michael McKee is our chief economics and policy correspondent, and he's got the lowdown on housing this morning? What are we looking at?
We're looking at kind of low down, a little bit better, but it's not a good long-term trend, which is something the Fed has to be concerned about in the housing market. Mortgage applications down just a touch last week. Single-family applications down just a touch, but they were down 6.6% in the month of May. And today we get new home sales for May. They were down 4.7% in April. They're only expected to be down 0.2%, but new home sales still a problem for the economy. Home sales in general, if you take a look at what's been going on with GDP, we had seen for a while that the overall numbers start rising for home investment. New home sales, as you can see, down, except for mortgage applications for new homes have been up because builders are giving people incentives, buying down some mortgage rates, some as low as in the 5s, and that has helped keep new home sales a little bit higher than existing home sales. Now to the GDP aspect of it, home sales in general. They have been contributing to GDP for a while, and then over the last year, they've fallen off tremendously, and there's starting to be a drag on GDP. And so let's see what happens when we get the new home sales report coming up at the top of the hour. Now, the interesting thing, Matt, is that even though home sales in general have not been good and new home sales have, as part of that, not been good, home builder stocks have been doing very well. And the home builders are way outpacing S&P. We focus a lot on the Magnificent Seven and the tech stocks, but
yes, we
surprisingly, home builders have outpaced returns for the S&P over the last 2 years.
I saw yesterday the market was driven by two chip makers, Nvidia and Chipotle.
Oh, that was bad.
Michael McKee, thank you very much for that. Mike talking about the economic data. It is really a market that is run by Nvidia. Right now, as I mentioned, we have seen the shares turn lower in the pre-market trading, and typically the direction of Nvidia will tell us the direction of the S&P 500. Nadia Lovell of UBS Global Wealth Management is still with us. Nadia, what's your take on the AI revolution? It's not only the chip makers. Obviously, you need the data centers. Recently, we learned you need DRAM. Of course, we're expecting people to upgrade their iPhones and maybe PCs. How important is this to you as an investor?
Yeah, it's one of our focus at UBS in terms of seizing the AI opportunity. I mean, we're starting to see a bit of a bounce back earlier, and at least yesterday. I mean, today we'll see how it goes. But it's further evidence to us that dips will be bought in the space. I mean, there's a lot of cash on the sideline. There are some people who wonder if they missed out, and there are even some investors who are still underexposed to tech and AI. We see this in some of our client base, especially internationally. There's this home bias, and so we've been advising our clients to really buy on the dip because we think that the AI theme is the theme of the decade. I mean, right now we're really focused on that enabling layer. So as you noted, the chips, the data centers, the power supplies that are really involved in the build out of AI. We continue to believe that there's significant runway ahead for this because of the supply constraint and the strong demand that you are seeing. We sort of without like even a single stock view. Of course, we'll be watching Micron earnings after the close because that's like the next major AI data point, if you will. And so we'll be listening very close for any trends on high bandwidth memories. But even outside of that, I will say, Matt, our thesis on semis, which is largely driven by AI, but you're also seeing some of these semiconductors benefited from a stabilization and a recovery in cyclical trends around smartphone, PCs, and servers. And so it's somewhat all interconnected. So we still are quite positive on tech here.
What do you like besides tech, Nadia? I mean, if this one sector that's rallied so far so fast moves out of the leadership spot, what takes over?
We also like industrials. We're most preferred on industrials. And I think, again, industrials could benefit from that, potential cyclical pickup. Of course, we've seen ISM manufacturing, PMIs kind of, flirting and oscillating around 50. New orders look like they could pick up. And so that could help in the back half of the year. But also, it goes back also to the some of the mega trends and AI story that industrials are benefited from. They're sort of the nuts and bolts in terms of the build out of the data center as well. well. And there's also benefiting from, nearshoring and onshoring, when we've even heard, comments around that in terms of around FedEx earnings last night, as well as sort of the automation mega trends that's happening in the U.S. as well. And so we think that industrials are positioned to benefit not only from cyclical, but also the cyclical tailwinds.
Anything you like? I mean, anything that's been hit hard, Nadia, that you think has fallen far enough to get back in? I noticed yesterday it wasn't just real estate that was down, but also consumer discretionary was now negative for the year. Those two industry groups are the only two of the 11 on the S&P that have fallen.
We are least preferred on those two sectors. And again, I want to make it clear that our call on consumer discretionary isn't so much a call on the consumer. We're still quite constructive on the consumer, but it's more of the makeup of the index. I mean, you'll have this index that skews more towards good. You'll also have the top two companies that account for nearly 50% of the index. When you talk about market concentration, this is one, in terms of market cap, the most concentrated sector. And as noted, he noted earlier about some softness that we're seeing in housing. That has implications for big ticket items. And so we think that will remain a headwind. And even also, like, EV sales has been bumpy globally. And so we think that there's more downside risk to estimates on the EV side. So still a little bit too early to jump back into consumer discretionary. If we can see some easing on the rate front, that might be the opportunity.
All right, Nadia, thanks so much for joining us. Great to get some time with you. Nadia Lovell there of UBS Global Wealth Management, talking to us about the sectors that she's interested in and those that she doesn't want to buy just yet. Quick note on FX. The yen is making some moves. Right now we're seeing the drop turnaround in the dollar yen. Right now 160 is the level, and that's about the level that we've been watching, but you can see a little bit of a change in direction there as top-ranking FX official Masato Kanda is speaking in London right now, and of course, in Paris right now. And of course, the thought is that if this currency, the Japanese yen, continues to weaken, that Japan will intervene on Friday. That's at least what market players are talking about as a possibility. Let's get a look at some of the individual stocks moving ahead of the opening bell. For that, we go to Abigail Doolittle. Abby?
Well, we do have futures lower, as you know, Matt. But first, let's take a look at two stocks that are working, starting off with the shares of FedEx, really popping sharply higher right now, up more than 13%. This, of course, after the carrier put up a much better quarter than expected, beating estimates. Importantly, they also raised their profit view. This comes after cost-cutting efforts, and they announced a $2.5 billion buyback. Investors really liking it, sending the shares right now to what could be the best day in 2 years. Also climbing, in fact, soaring, Rivian shares are up more than 30% on the announcement of a $5 billion EV pact with VW, where they will be jointly developing battery-powered vehicles and software. I was surprised to note that the bearish short interest on this stock is not as high as I thought. It's 16%, which is high, but with this kind of gain, I thought it was a much bigger squeeze. But there is clearly a bit of a squeeze going on there. Southwest Airlines, one of the stocks declining on the day, down 4.8%. They pre-announced to the downside. They cut one revenue view to RASM to down 4% to down 4.5% from the previous view of up 1.5 to 3.5%. That's pretty serious view. And the management saying complexities in adapting its revenue management to current booking patterns in the dynamic environment. I guess a very fancy way of saying demand's not quite as strong. And then Nvidia, you were mentioning that turn to the downside. Matt, this is really remarkable, as you know, or noteworthy, given the fact that not so long ago in the pre-market, it was up more than 2% after yesterday's nearly 7% gain after the 10% drop in 3 days. Now back down 0.6%. It's going to be very interesting to see how all the volatility for Nvidia chips and AI plays out.
Yeah, absolutely interesting. And of course, yesterday was fascinating because only 113 stocks gained, and the market was up 0.4%. That's the worst breadth, Abigail, that we've seen in 24, 25 years. It
was really noteworthy. And from a sector standpoint, I believe at the end of the day, there were 2 or 3 sectors higher, the rest negative, speaking to that negative breadth that you're talking about. And what makes it really noteworthy or worth watching beyond the fact that it's just the worst breadth in such a long period of time is that we're having these mini sector rotations day by day. So on Monday, we had one into value. Yesterday, violently into growth. Today, it's going to be interesting to see how it plays out. Right now, it looks like it's perhaps more evenly dispersed, but with Nvidia going back to the downside, maybe it will be value's day to shine.
All right. Very interesting markets indeed. Great that we have you with us, Abigail Doolittle. And we're going to talk, by the way, with one of Abigail's sources a little bit later about the commercial real estate market. Very excited for that. Coming up, with the EV market in flux, two automakers enter a $5 billion joint venture.
It is a lifeline for Rivian, and I think really it's really important not to get too carried away. This is a huge sigh of relief, really, rather than a cause for celebration.
We're going to take a look at the deal between Volkswagen and Rivian next. This is Bloomberg.
This is a huge sigh of relief, really, rather than a cause for celebration. Yes, it's good news. We know that the EV market, long-term wise anyway, is certainly something that's meant to be, it's going to be very prosperous. But it's, is $5 billion enough, really, for them to meaningfully rival what Tesla is doing, and particularly some of the players over in China as well?
One stock that we're watching this morning is Rivian, the EV maker surging after announcing a $5 billion joint venture with Volkswagen. The deal allows VW to get access to the startup's tech and really its huge brand equity for a much-needed cash infusion. Joining us with more is Bloomberg Technology co-anchor Ed Ludlow. So, Ed, talk to us first about why this automaking behemoth, right? Volkswagen has like 12 brands, all of which everyone has heard of, needs this joint venture with a company that only makes 57,000 electric vehicles a year.
Because for Volkswagen, their efforts in software have been going very badly. The first phone call that I took last night from somebody close to Rivian and Rivian's board was like, look, this is a great deal for Rivian, but it speaks to Rivian's competence in software. What I'm hearing is that Volkswagen just had major issues with Cariad, the unit that it's set up to basically develop a software suite for everything from OS through to autonomous driving capabilities to compete with Tesla. They just couldn't do it. Think about the types of people that work at Volkswagen. They just didn't have the talent. So Rivian was seen as like a really good quick fix because Rivian's good at software and they've got good talent there.
I was talking with Monica Raymond, who covers Volkswagen for us out of Berlin, and she noted that VW has penciled in 108 billion euros in investment in EVs and digitalization. The previous CEO, Herbert Diess, was pouring tens of billions into Cariad, right? But it's lost billions already in its first years of existence. They just don't make much headway with a ton of cash.
Yeah, and so therefore, like $5 billion, up to $5 billion, because like the devil's in the detail of the structure of this deal, kind of seems like a drop in the ocean. I would focus on that because on paper, Volkswagen has the potential to take quite a controlling interest in Rivian. And so Rivian's quite clearly had to cede something here, give something up. But initially, it's an equity stake through an unsecured convertible dated December 1st, with the promise to buy $1 billion of equity each year, 2025, 2026. But if the stock goes up for Rivian, think about the dilutory effect. VW might not end up with that big a percentage of the company, but it's a good hedge. They're forming this joint venture where, Volkswagen gets access to Rivian. So if Rivian is as good at EV technology as the market believes, VW gets that. Rivian gets the brand recognition, I suppose, that you just flagged. One note of caution, though, I would say look at the final paragraph of the story and how many joint ventures Rivian's pulled out of over the last 5 years.
Obviously, Amazon owns a huge stake in Rivian. Ford had a huge stake in Rivian. They canceled a deal with Mercedes-Benz. But I really think the Rivian brand is going to be helpful to Volkswagen because people love these vehicles, right? They're expensive, yes. Rivian loses like 40 grand on each sale. But we're talking about 1,000 horsepower in the quad motor Rivian, right? Massive amounts of torque. It's a real status symbol, and they're supply constrained, aren't they? I mean, they could sell as many as they could make.
Yeah, and really the story with Rivian is trying to work out the manufacturing side of what they're doing. A lot of emphasis on this story is the next generation Rivian, R2, R3, which is kind of their attempt to compete with Tesla's Model Y. They had shifted the launch of that vehicle to their existing plant in Illinois but they remain contractually committed to building a new plant in Georgia by 2030 and investing $5 billion. So the cash injection from VW helps. The question is, what does this JV between the two actually do? A lot of folks were speculating about the Scout. I don't know how interested you are in the Scout project,
I have been speculating about it myself this morning. I mean, they could just rebody an R1S to make it a Scout.
But then look at the Scout's profile and look at the R2, R3, and I use this term not lightly, but frenemies. You know, Rivian's had to give something up here, and I'm still trying to work out what it is beyond the kind of positive headline, and I get the stocks up a lot, that Rivian's getting access to, because what Rivian needs is capital, and it's up to $5 billion, not a certain $5 billion, but they also need some manufacturing help as well. I
mean, that's the hope, right? That's why we see this 36% pop in the stock pre-market. Rivian gets the money to build the Georgia plant. Maybe they can go from 400-volt architecture to 800-volt. Maybe someday they can actually put Apple CarPlay in a $100,000 vehicle. That boggles the mind that they don't have that. The problem is, you know, Volkswagen made a partnership with XPeng. The stock soared in China and now has lost 2/3 of its value.
Yeah, and again, I look at Rivian's track record with JVs. I think the point is that for the legacy OEMs, they're still hedging their bets. You look at Ferrari now talking about doing a hybrid, for example. There's a recognition that this is one strategy. You acknowledge the competence of the pure play EV makers. Rivian does have a great product. Good talent. It just needs help executing on it, and execution's kind of key. They've de-risked the balance sheet with Rivian with this partnership. And at the same time, VW can hedge its bets, continuing with many gas or combustion engine models, and continue to look at hybrids, as many of the legacy OEMs are, with the offset of the partnership with an EV maker that's focused on one thing and one drivetrain.
Right, Ferrari's SF90 Stradale already a plug-in hybrid. I think you should take a spin in that, Ed, when you get a chance. Bloomberg Technology co-host Ed Ludlow, definitely want to tune in for their program at 11 a.m. for more on this, I think, massive story. And Ed is our EV expert. I also think you should pick up the new issue of Bloomberg Business Week. You get an exclusive interview with LVMH chief Bernard Arnault, often the richest man in the world when he moves up and Musk moves down. But it's a whole new format for the magazine as we relaunch Business Week. Coming up, morning calls, and then later Jay Hatfield joins us. He has an S&P target of 6,000. This is Bloomberg. Welcome to Bloomberg The Open. I'm Matt Miller. Just ahead of the stock market open, we get a whirlwind of activity in FX and rates. Here's the Bloomberg U.S. Bond Index hitting its highest level so far this year after, well, really some divergence shows its face. The Fed seems far away from cuts. The ECB seems much closer, and the yen falls against the greenback. This is the countdown to the open. I'm Matt Miller, moments away from the start of trading, and we have a lot of activity in currencies and in bonds right now. The yen hitting a fresh 38-year low against the dollar after candid comments out of Paris. The dollar hitting a fresh high for 2024. The euro falling against the dollar as well, and a sell-off in treasuries pushes the yield up. Nonetheless, let's focus in on stocks, at least for a moment, as you hear the opening bell on the NASDAQ and the New York Stock Exchange. We're down on S&P futures, and you'll see us dropping the cash trade as well. That's because Nvidia has turned lower. NASDAQ also going to be down, as well as the small caps. But let's pan over to the other board right now. I usually dance right past this. Look at the euro. Down with a 106 handle right now. Some real divergence forming as it looks like the ECB is going to cut again, even with all the election volatility over there. The Fed, Michelle Bowman, saying it's going to be difficult to do that because the risks to inflation are to the upside. Right now, you can see a sell-off in treasuries pushing the yield up to 4.30. We were at 4.25 this time yesterday. And NYMEX crude just hovering around $80 a barrel. We don't have the yen there, but we should probably pull it up right now. Their top currency, Japan's top currency official talking in Paris, saying you've seen drops too far, too fast. That may indicate that we're headed for some intervention. That's what a lot of talk in the markets is about. Expectations possibly for Friday, but could it come sooner? I guess, as we go over 160 yen for the U.S. dollar, headed now towards 170. You can see right now we're trading there at 160.58. In terms of stocks, one that we want to watch at the open, one stock that isn't Nvidia that we want to watch at the open is FedEx. It's up after forecasting profit better than Wall Street's expectations. For more, we're joined by Bloomberg's Abigail Doolittle. Abby, what do we see?
Yeah, it's up in a big way, Matt, up more than 10%, heading to its best day in 2 years. And this comes on a number of factors, including that raise of the profit outlook that you were mentioning. They've been cutting costs. They're saying that they will achieve $2.2 billion worth of cost cuts by the end of this year. They also did beat estimates for the quarter. That was a modest beat, but nonetheless, it does signal a slowdown in the decline for their parcel business. So that is really pretty important. The CEO also talked about the process of consolidating the Express, the Ground, and the service units. This could be a really big shift for their business. Apparently, Express has been having a bit of a stall given the inflationary environment, folks opting for the Ground. Also, they hinted at the possible divestiture of their freight business, JP Morgan in particular. Some analysts surprised by this. But overall, Matt, what really amazes me about this stock is it's been stuck in a range between about $224 and $290. It is basically at the top of that range right now. So investors are either going to need enough good information to push it up and out of the range, or we could actually see FedEx go right back down in that range. More information is needed, but right now investors encouraged by these recent results.
All right, Abigail, thanks very much. Abigail Doolittle talking about FedEx. Meanwhile, General Mills is dropping at the open, and it's the biggest drop for the cereal king since May of 22 as shoppers pull back on spending. For more, we're joined by Bloomberg's Simone Foxman. I would think, when money is tight, cereal's the only thing I eat.
Yeah, but frankly, General Mills has been passing on a lot of its net sales increases in pricing. And finally, what we are seeing is this slowdown in actual volume coming home to roost. We're seeing declines over 5% in those stocks today. That's pushing this stock into negative territory on a year-to-date basis. And when we look at some of these results in the fourth quarter, we saw organic net sales decline 6%. That's roughly double what analysts on the street were anticipating. A lot of this weakness coming from North America, from the pet segment. Canada actually a standout here with sales increasing mid-single digits. For the fiscal year just ended, we were watching organic net sales down 1% year on year. And one of the troubling things for analysts as well is the guidance, expecting organic net sales to rise 0 or to be flat to up 1%. That is less than the street anticipated. Jefferies says this is just evidence that value-seeking behavior is persisting. And again, we look at food at home inflation up just 1%. There is no longer that ability to come and pass those price increases through. Instead, the CEO says we really got to focus on investment. Market doesn't love it, though. All
right, Simone, thanks very much. Simone Foxman there talking to us about the other GM. Now, Nvidia shares actually higher right now. We're trading lower in the pre-market. Oh, nope, now the cash trade is lower. A little bit of volatility there, and the S&P is down again. I just wanted to point that out as we talk about Micron. It's been gaining ahead of its earnings report after the bell today. And, of course, Micron could be a beneficiary of the Nvidia AI craze. Natalia Knijevic joins us now to talk about Micron. And, Natalia, what do we expect?
So Wall Street is expecting Micron to post about $6.7 billion of revenue in the past quarter, and that would be above company's guidance for both earnings and revenue. And this would be an 80% jump from a year ago. So these strong results could primarily be driven by pricing power. We know that Micron has been raising prices over the past 6 to 9 months, and analysts expect this to continue throughout 2024. So we know that supply chain remains constrained. Demand is improving for PCs, servers, smartphones, which is good for a company like Micron. And we know that revenue has been increasing, gross margin has been increasing, and analysts expect that Micron can post its first positive free cash flow. So we know that there are some concerns about production capacity around DRAM. This is a memory chip that is produced, about 60% of its capacity is located in Taiwan. There was an earthquake and it disrupted production capacity. But Bloomberg Intelligence is saying that price increases can potentially offset any production impacts for DRAM. Analysts will be watching for any commentary around CapEx for 2024 and 2025. Of course, any comments around demand for AI-related products as well, and any updates on DRAM production. The stock overall is up 65% year to date. Analysts are really positive. The stock has got a few updates ahead of earnings. We have 37 buy ratings, 2 hold, and only 1 sell rating for this stock.
All right, Natalia, thanks. Natalia Knedjevich there talking about Micron and DRAM. And by the way, Ed Ludlow points out to me it's not just about DRAM, but also HBM, which is high bandwidth memory, a kind of chip I didn't even know about. So thanks to Ed. Tune into Tech at 11 for that. Joining us now is Jay Hatfield, founder and CEO of Infrastructure Capital Management. And Jay, you know, it's interesting to see the volatility in Nvidia today, but yesterday we saw Nvidia as one of the sole drivers. I mean, only 113 stocks were up on the S&P 500, and the index was up 0.4%. How important is this stock?
Well, it's really critical. It's the reason the market's up this year so far. But it's the reason that we are bullish on the stock market is it's broadening beyond Nvidia. And most importantly,
but yesterday's breadth doesn't show that, right? I mean, It was the second worst breadth this century.
Well, this is a bull market pullback. So June's usually a terrible month for stocks, but that's how bullish this market really is this is a pullback where you get rotation. So every other day it's tech's up. Today, actually, most things are down, but tech's up, value income stocks are down. That's what we invest in, so we're very focused on that. But other days, Nvidia's down. Well, guess what? All of our stocks are up. So that's what happens in a bull market during June, which usually the market would be way down. It's just up at all-time highs. So pretty normal behavior. We're bullish, though, when we get into earnings, we'll get a broader based rally.
So when you say all of our stocks, what are you talking about? What do you see as value? What do you like right now?
So we like large cap dividend stocks, small cap dividend stocks, preferred stocks, anything with yield, which is not in favor. Rates have traded off 45 basis points this year. So those are out of favor, super cheap, trading below 15 multiples, no hype whatsoever. And so we think that rotation will start, and we'll have a power rally in the summer where we'll have both major sectors going up.
Do you need rate cuts for your story to play out the way you want it to?
Rate cuts are lower 10-year. I mean, if the 10-year just magically went down, which almost never does, but we think that we're going to get weak data. The labor report will be indicative. It's very volatile, so it could be misleading. But we've seen claims weaken. So we think that there'll be an anticipation of a September cut. And in July, they probably won't cut, but they'll be more dovish and lay the groundwork for cutting, which should power a rally during the summer.
So payrolls, Neil Dutta this morning was saying only 2 data points matter. Payrolls and inflation. I guess PCE, right? Because that's what the Fed says is their preferred measure.
Yes.
We're going to get that. How do you see inflation trending? Continuing the downward trend? Did we just see a pop that was out of place in the beginning of this year?
We absolutely believe that. Oil is a great short-term indicator. It was way up in the first quarter. It's way down in the second quarter. So, and PCE is going to be 2.6, so that's low enough for the Fed to cut. All they need now is the labor market to clearly soften, and even Mary Daly mentioned that a couple days ago. So there's early signs that the Fed will figure this out and at least indicate in July that they're going to cut in September.
One of the things I thought was interesting from Bowman's speech a couple of days ago when she first said, you know, the risk to inflation is higher, no need to cut right now. I know she's only one, you know, governor, member of the Federal Reserve Board of Governors, but she said that the amazing amount of immigration that we've been getting, the floods across the border, have really boosted the supply of labor, and that the new restrictive approach that the Biden administration is trying to take, the restrictive approach that you know President Trump is going to take or if he's elected, will kind of goose the labor market a little bit. How important do you think the November election is?
We think that the election will be fine for the stock market. The most likely case, when you look at all the probabilities, is we have divided government. House may go to the Democrats, Senate to the Republicans. That's the way the math looks. And I really don't know on the presidential. Turnout is critical because nobody's going to change their mind. So if we have divided government, we'll have lower government spending, more stability. We'll have the opposite of Europe, where you have a parliamentary system and there's a huge change in policy. So we should have gridlock, which is good for stocks, because rarely do federal government policies help corporations.
Lower spending, you mentioned. There's been a lot of talk about deficits recently. Bill Dudley is out with a column on the Bloomberg saying there is a reason to worry about it. Steve Weissman was on surveillance yesterday saying he doesn't care. I've talked to Ed Hyman, who says the bond market doesn't care and the dollar doesn't care, and we just hit a fresh high for 2024. I don't care. Do you care?
Well, we care. Our estimate is that running these irresponsible deficits chops about 1% off of potential U.S. growth, because savings equal investment, so higher government spending crowds out investment. But in terms of growing at a normal 3%, we don't think it's going to affect it. And the most important thing is not fiscal policy, but monetary policy, global monetary policy. If we get these rate cuts, we're estimating $2 trillion of injection of capital. And so that's way more important than our normal kind of 5-ish% budget deficit, which we've been running for 20 years since Clinton was president. So that's just normal, standard incompetence at the federal government.
Jay, thanks so much for coming on. Really appreciate your candid take there. Jay Hatfield of Infrastructure Capital Management. They recently raised their S&P target to 6,000, joining ISI, Julian Emanuel, on that bullish note. Coming up, betting big on commercial real estate.
So the good news for commercial real estate is, and it's very good news, is valuations have stabilized. It's a big market, and there's lots of really attractive deals to do. That's the good news. The bad news is that there's about $1 trillion of this debt that's upside down, where there's no equity value left.
Yeah. That's not bad news if you're buying. We'll speak with Namdar Realty Group CEO Igal Namdar next on the firm's most recent big purchase. This is Bloomberg.
So the good news for commercial real estate is, and it's very good news, is valuations have stabilized. It's a big market, and there's lots of really attractive deals to do. That's the good news. The bad news is that there's about $1 trillion of this debt that's upside down, where there's no equity value left, and the creditors have to work through this process of workouts.
That was Marathon Asset Management Chairman and CEO Bruce Richards. Another New York City office building was sold at a steep discount amid the deepening commercial real estate crisis. Empire Capital and Namdar Realty Group agreed to buy an office building owned by Related Fund Management for less than $50 million. That's roughly a 67% discount. Quite a deal. Joining us now is the man who made it, Namdar Realty CEO Igal Namdar, along with Bloomberg's Abigail Doolittle. And Abigail and I, Igal, have been fascinated by this pocket of investing and by what you and your company are doing here. I got to ask you first about Bruce's comments that valuations have stabilized. That seems fairly optimistic after you do a deal like that. What are you seeing?
I mean, I agree that this should be the bottom of the market. It should be towards the bottom, at least. You know, we're right in that level, and I think that the big issue is going to be all this debt. I said that I believe that most of the CMBS that was placed pre-COVID on assets that are not top tier, I would say A-plus buildings, anything outside of that, majority of that is on the water. You know, and lenders are working whether they want to take it back, whether they want to make a deal with the sponsor, and just there's a lot of problems right now in the office space.
So in this kind of environment where you can buy an office building at a 67% discount from a major player, I mean, a related affiliate, that's pretty incredible. It speaks certainly to your negotiating skills. But what is the process? Are they coming to you as a buyer of last resort, or are you scouting out buildings that are of interest to you where you know the debt is underwater, that there's some kind of problem?
So right now, the best way to purchase these assets is through arm's length transaction with brokers marketing it. This was a short sale, so the banks want to go through the process of vetting out all the buyers and see who's the best buyer, who's willing to pay the most and the surety of close. And we've built a great reputation over the years of...
Surety of close is key, right?
Yes, yes. And us being able to do our due diligence up front and sign hard deposits and close immediately gives us an edge in this market, because we've been waiting for 20 years for this moment when others were, we were fearful when others were greedy, and now we're greedy as others are fearful. That's a very smart man said that. And now it's our time to go out there. We're very liquid, and we want to be able to take advantage of this situation, correct?
Yeah, so that discipline is really paying off now. Talk to us about that liquidity. Is that really just from having built dry powder? And also talk to us about the connection with Namdar. Does that help you with financing?
Yes, so we've been doing our thing. When New York City prices were very high, we wouldn't be buying stuff. We would be buying our retail throughout 38 or 39 states. And we're well diversified in that area. We still have, that's our core business.
Your retail space, the mall business.
Malls and shopping centers. But now we've seen the prices of these office buildings have dropped so much that it's hard to not make money at these levels. And others have their challenges with the debt. They really are not in the position to be buying new deals because they're dealing with their problems, with the current lenders, with not being able to do build outs. And I think there's two advantages for our position. One is that we're able to buy these at a steep discount, which helps with making money. Secondly is we can afford, we have the liquidity to do the build outs, to do the tenant improvement work, to do the base building work, to modernize the lobbies, modernize the elevators, all this stuff that needs to get done in order to sign up tenants. Not only we can help to keep our tenants by being able to pay and invest in the tenant improvement work, and also being able to buy new tenants from other buildings that are in How
much is it costing you to refit? Because I know that's a big chunk of change, right? I'm looking at deals that you're doing for $100 million, $150 million, $170 million, but you still have to add, I'm guessing, $10 or $20 million to refit these offices so you can get new tenants in there.
Yeah.
How much are you looking at on average in terms of refitting?
So, it's a very capital intense business. And I think for that reason, our strategy is you have to buy the better buildings. You have to buy outside of New York, we're focused on A assets, the top 3 or top 5 buildings in that marketplace, because the tenant improvement work doesn't change whether you're in a C building or an A building. The sheetrock and it still costs around the same. So the payback is way better if you own the better assets, and it is intense, and that's why we have to buy these assets at a steep discount.
So I have to ask the question I think everybody wants to know. You're talking about the steep discount. Bruce Richards talking about the idea that we're at the bottom. What are we talking? On 3rd Avenue, can you buy a building 25 cents on the dollar of what it was for B and C, or what kind of discount is it? Where are values?
I would say it's relative. An occupied building on 3rd Avenue pre-COVID versus a vacant building today on 3rd Avenue could be more than a 75% discount.
More than 75 cents. So are we talking 15 cents? I mean, that's incredible.
There are assets that are vacant that may sell in a double-digit price range.
Wow.
Under $100 or right around that range.
Wow. It's still a lot of money, though, that you're spending, right? I mean, where are you getting the financing? Are you working with banks? Are you selling bonds? What markets? How's it look?
So in our situation, we've always believed in low debt. So we don't have a lot of debt on our balance sheet. We have a good cash flow. And banks would finance us because they know we don't over leverage it. And we're willing, in some cases, to give personal guarantee on some loans, while others want to do a non-recourse loan, which is almost impossible in office space today. We also have an Israeli company. We're public in Israel as well. So that also helps with them build up our trust over the last, I would say, 7-8 years. And, so we're able to have access to Israel money as well.
Igal, thank you so much for coming in. It's so great to get your take on this market because it gives us an insider's view that otherwise we wouldn't normally have access to. And Abigail, great reporting on commercial real estate as well. Abigail Doolittle and Igal Namdar from Namdar Realty. Coming up, the market moving events that you need to be watching this hour. There's a lot going on. That's next in our trading diary. This is Bloomberg. Time now for the Trading Diary, what you need to be watching today and next week. We're going to get new home sales at the top of the hour, then a Treasury auction on $70 billion of 5-year notes this afternoon. Very interesting to see as we get the sell-off in 10 years today, pushing yields higher. Micron, as we've been telling you, reports after the bell. Very big deal in AI, so we'll see what they have to say. Tomorrow brings the first debate between President Joe Biden and former President Donald Trump. We're going to round out this week with the all-important inflation number, the Fed's preferred gauge of inflation. The PCE comes out on Friday, and then, of course, next week, we're going to get the non-farm payrolls number, the granddaddy of all economic statistics. This has been the Countdown to the Open. I'm Matt Miller. This is Bloomberg.